before we start with our today's learning. You're able to see my screen now?
Yes, sir. It's visual.
Okay.
Yeah.
So we started with the basics of understanding direct tax, indirect tax. Then we have understood the present regime, like sales tax to VAT, VAT to GST. Concept of input tax credit, the base why input tax credit was brought in to eliminate cascading effect of taxes. Then the relationship between customs law, GST law, which is under the Ministry of Finance, we have understood in a broader way. Customs law tries to levy something called sales tax, VAT, GST when goods are imported into India. This is also we have understood. The intention of customs law is to make a level playing field for the goods which are imported into India, if at all they are manufactured or traded in India. That is where they levy the equivalent sales tax, central excise or GST on the goods which are imported into India. We have discussed this Maruti and Fiat case where Fiat has imported their goods in semi-knocked condition. Then we have discussed on what is a bill of entry and the element of GST which appears on this bill of entry. Then understanding when we talk about business, the business is generally bifurcated into small, medium and large, where exemption is there for people who have a threshold limit less than 20 lakh or less than 10 lakh. Medium, who have a small business who are permitted to do business under composition scheme. Then the regular people who are registered as a normal business payer. Then levy point of view, we have understood that only those goods or only those services where GST is applicable will be applicable. From here, where I have taken to your Constitution of India, I explained Article 265, where there is no power authority, you cannot levy tax without authority. Keep in mind, income tax, indirect tax, this Article 265 is a cardinal principle. Only when there is a authority to collect taxes under the Constitution, someone can collect taxes. Then concept of reverse charge mechanism, 2004, I have explained what did Chidambaram did. Then we have understood this concept of charge, that is levy under the GST law, where I have identified these 5 elements. Levy should be there. There should be a supply. There should be a value on which GST has to be paid. I should know what is the rate of tax. Last but not least, the person who is liable to pay tax. These are the 5 elements which are relevant for us to understand when a charging section has to be evaluated. So this particular charging section similarly is applicable for even 9.3 reverse charge mechanism. 9.1 is under forward charge, 9.3 under reverse charge. Then we started with this concept called input tax credit under GST law, where section 2, clause 63 has explained what is your input tax credit under GST law. And we broadly understood what all elements which are there when we talk about input tax credit. So input tax credit appears on a tax invoice, input tax credit appears on import or a self-tax invoice. Now, when we start with section 16, I'll just read the initial opening paragraph, what 16 says when we want to take input tax credit. Every registered person, that means to say when I talk about input tax credit, the main element is registered person. If a person is not registered, then concept of your input tax credit doesn't come into picture. So every registered person shall, subject to such conditions and restrictions, that is what we have discussed little later, may, in the manner specified under 49, section 49, be entitled to take credit of input tax credit charged on any supply of goods or services or both to him, which are used or intended to be used in the course of furtherance of business, and the said amount shall be credited to electronic credit ledger. Where to claim input tax credit, I should have a document. This is the first requirement. Eligibility to claim, I should have an invoice. I should have received these goods or services. I should have communicated the details from the supplier on the basis of GSTR 1, which is appearing in my GSTR 2B. The supplier has to pay the tax to the government. And last but not least, I should have filed GST R3B to avail input tax credit. These are the 5 basic conditions which were there under Section 16. From there, we went to understand this availment of input tax credit. Turnover less than 20 lakhs, I'm not liable to register. But once I cross the turnover of 20 lakhs, I get registered and I pay GST. That point in time, like the inputs which is available in stock, I can take the input tax credit by filing a form called ITC-01. Then scenario 2, when I convert myself from composition to regular scheme, then I can take the input tax credit on closing stock. And a new element called capital goods, I can take my input tax credit. There's a form which needs to be filed, which is called ITC-02. ITC-02. Sorry, this is also ITC-01. Then third, when there is a sale, transfer of business, that point in time, there is a transfer of input tax credit from one entity to another entity using a particular form called ITC-02. I think this is what we have discussed in our last class. These are the basics which we have discussed in our last class. So let's continue with our input tax credit. From here, we will get on to the conditions for input tax credit. I'll just show you this section 16 where we started with. So, little delay in the internet. Meanwhile, little overwords, I'll explain. GST law says that under section 16, you can claim input tax credit if the goods or services used or intended to be used. Used or intended to be used. For what? For furtherance of business. Furtherance of business. This is a basic criteria where your element of input tax credit comes into picture. Now, what do you mean by used or intended to be used? See, used is where I should have consumed. I should have consumed those purchases for my business. Used or intended to be used. I don't use now, but I use a later point in time. I use at a later point in time. So when I buy stock, this is the language they use. You shall be entitled to take input tax credit, which is charged. Which is charged. Charge is on forward charge is on reverse charge. On any supply of goods or services or both to him, which are used or intended to be used. Let's take an example of a trader. I purchase laptop, I sell laptop. When I purchase and sell, used in my business, intended to be used. Sir, I have purchased in March, I would sell in April. Intended to be used in subsequent point in time. That is, that usage is in the course of furtherance of business. Furtherance of business. Now, this furtherance of business is little important. And said amount shall be credited to electronic credit ledger of such person. This is what the charging session talks about. Now, so whenever I have a transaction, whenever I have an invoice, or whenever I have a bill of entry, what I have to do is, can I take input tax credit? If I have to question, the basic answers should be, it is used or intended to be used. Intention to use should exist. Then it should help for business. It should help for business. Let's take a couple of examples to understand. Say XYZ Limited purchased 100 laptops. Now these 100 laptops, they purchased on say June 25. Out of these 100 laptops, let's assume that 80 were given to employees, 20 were given as gift, maybe to customer, maybe to a trust, maybe to government organizations. Now, here, business is where the GST law talks about, where there is an advancement, where there is a commerce, where there is a commercial activity which takes place. Now, the definition of business is something which is important for you to understand. Every term, please keep in mind, every term will be defined under the law. If it is not defined, then we can approach the government authorities to clarify what does that mean. Business includes trade, commerce, manufacture, profession, vocation, adventure, wager, any other similar activity. There should be trade, there should be commerce, there should be manufacture, profession, like no advocate, chartered accountants, doctors, those are profession. Or activity or transaction in connection with incidental or ancillary to clause A. Activity or transaction in the nature of clause A, whether or not there is a volume, frequency, continuity, regularity of such transaction. Now, this means to say, if I'm doing a seasonal business, may not be 12 months. I do once in a month, once in a quarter. Even then, it could be considered as a business. Supply or acquisition of goods, including capital goods and services in connection with commencement or closure of business. I start a business, I buy those assets. I close the business, I sell those assets. Provision by a club, association, society, or any such body. Now, this clause E with respect to this residential welfare association, as an association of persons, I buy goods or services to provide to the members, club, trust. There also I can take input tax credit. Admission for a consideration of person or any premises. Like you have this museum, then any show which is conducted, event. Services supplied by a person, holder of an office, which is in relation to IASD. We will talk later. Club, totalizer. This you have race course road where we have this horse betting, or a club in general. Activities which are undertaken by state government, central government, or local authority in which they are engaged as a public authority. Now, these are all they have defined as a business. So when you want to take input tax credit, we should have met those conditions which are mentioned in your business. So here, 80, I can take input tax credit, 20, I cannot take input tax credit. So this is what section 16 talks about. When you want to take input tax credit, please examine your entitlement and then take your input tax credit. Yes, sir.
Especially when you are giving gift to customers. That's also can be claimed as a furtherance of business.
There is no consideration. The supply should happen where I buy, I sell. So there is a definition called supply business. Only when that supply happens, when government gets a revenue, they are entitled. You buy and you give as a gift, donation. There is no revenue which government is getting. The government says value addition. Where is the value addition? The cascading effect of taxes. When you buy, yes, you use it for furtherance of business. What is the value addition you're buying? You're buying for 100, you're selling for 0. When there is no validation, the concept of ITC is not met. Valid question. When you are giving gift in the course of business, why it should not be? So the law says that there should be a business, there should be a validation, which we need to prove. Now, conditions one by one when we understand. Basic conditions, I should have an invoice, I should have document, all those things we have understood. Going further, the law says this way. Look, when you have purchased those goods, you should have made payment. The payment should be made the basic value, that is the taxable value, plus tax, that is your invoice value. This invoice value should have been paid within 180 days, within 180 days from the date of bill, from the date of tax invoice or a debit note. Now, what is missing here? In case of imports, is there any condition? There is no condition. I pay import duty, I bring the material. The concept of payment doesn't come in case of imports. Other than imports, wherever I have to claim input tax credit, I should have made the payment to the vendor within the span of 180 days. So this condition is applicable for forward charge, not applicable for reverse charge mechanism. In case of reverse charge mechanism, I'm going to pay the tax to the government. So this condition of 180 days is applicable only for forward charge. Now, probably if you ask, so why is that lawmaker is bringing this payment 180 days? Why should they get into this business? Like as a part of business, I could have paid in 200 days. I could have paid in 300 days. I could have done anything. Now, let's take example. Let's say big contracts, like where there's a construction which is involved. So I do a construction of a building. There's a retention period. I tell to my customer, look, I'll pay you 80%, 20% I don't pay now. I retain that 20%. I'll pay after 2 years. Now that retention, this hold is to ensure the values as per performance. Now they constructed the building. What if the wall falls off? What if there is a crack? What if there is seepage? So to ensure that contractor did his job, I'll hold this money for 1 year, maybe for 2 years. Now, government says you should have paid to the vendor within 180 days. The logic here is, if they don't put this condition, there's a concept called bill trading, where just for the sake of input tax credit, like let's take example A, who is a seller, raise invoice on B, who is a buyer. Later, B raises an invoice on C. B happens to be a seller. C happens to be a buyer. C in turn may give it to D, who happens to be a seller. D happens to be a buyer. Now, this is called your value chain. This is called as your value chain. Now, for the purpose of ITC, invoice is raised. Later, this invoice is written off as bad debt by A. Now, when he says bad debt, he won't get that money. And this fellow doesn't pay to this A. Later point in time, D raises invoice on A. Now, this is becoming a loop. Like, no, within that loop, the invoices are getting rotated. A bills to B, B bills to C, C bills to D, D again bills back to A. Is there any revenue which government is getting? Absolutely no. To block this chain, they say that, look, you ensure that you pay to your vendor within a span of 180 days. Look at the way the law draftsmen are thinking. When you make a law, you shouldn't think only from that particular short span of point in time. How does the business operates? Where is the leakage in the system? How to plug that leakage they are thinking. So this is the reason they say within 180 days, the payment should have happened to the vendor. That is what they say. For this purpose, they brought in something called Rule 37. Under Rule 37, this concept of 180 days was discussed. So what happens? If paid, ITC is intact. ITC is intact. No one will question. If not paid, government says that reverse the ITC. Reverse the ITC along with interest. Along with interest. So let's assume that the bill was given on 1st April 2025. From here, 180 days. Let's assume that on 4th October 2025, this concept of 180 days is over. 6 months. So assuming on 4th October, 180 days is over. As per books, on 13th December 2025, the payment actually was paid to the vendor. As per law, on 4th October, this ITC avail should be reversed plus interest also should be paid. So the law says that don't worry. Whenever you make the payment, again, reclaim this particular credit. This is what law says. When you interest is a cost. Once I pay, it's a cost. Like Tirupati Hundi. Once you put anything to Hundi, nothing comes back. So ITC, whatever you have paid, that I am eligible to reclaim. This is what the concept of reclaim came into Rule 37. This there is a table called Table 4B2 in GST 3B, where I'll reverse and reclaim happens in 4A5. My original reversal happens in table 4B2. Reclaim happens in my 4A5. This is your GSTR 3B point of view. Now, exception to this rule 37. Exception to rule 37 with respect to any tax invoice, with any tax invoice or a debit note issued on distinct person, which is issued on a distinct person, or related person, related party. Let's take an example. So there is a company called ABB Limited. ABB Limited is registered in the state of Karnataka, is also registered in the state of Tamil Nadu. Now, for the purpose of Section 25, these two people, as per Section 25, are called as distinct person. Distinct person. That means person who have same PAN but registered under GST law in various states. I call them as distinct person. So if goods are supplied from Karnataka to Tamil Nadu, seller, buyer. Stock, we call this as a stock transfer. We call this as a stock transfer. In case of a stock transfer, the concept of payment is not there. They say that it is deemed to be paid. Deemed to be paid. This is a concept of deeming to be paid, which is an exception to your section 16 with respect to 180 days. In relation to related party, let's assume that XYZ Limited, and there is a related party that is a sister entity called XY Limited. This is a holding company. This is a subsidiary company. Even in case of a related party transaction, law says that if they raise an invoice only for the purpose of Schedule 1, though there is no transaction, though there is no consideration, just for the purpose of Schedule 1, you raise a tax invoice. Then law says that there is a deeming fiction even for related party transaction. This is what exception with respect to your payment of 180 days. Any doubts before we go further?
This related party
Huh.
has been written in the act. Otherwise, From whether to state perspective,
There is a definition under section 15. When we visit section 15, related party will be defined. Valuation, in valuation, there is an explanation. For the purpose of this act, persons shall be deemed to be related if such persons are officers, directors of another business. Such persons are legally recognized partners in business. Such persons are employer and employee. Any person directly, indirectly owns, controls, holds 25% of more of the outstanding old stock share of both of them. One of them directly or indirectly controls them. Both of them are directly, indirectly controlled by a third person. Together, they directly, indirectly control a third person. They are members of the same family. The term person also includes legal person. This is your definition. Please keep in mind, any term we come across, usually that gets defined in the law. If it is not defined in the law, then there is a room for litigation. What I understand, what officers understand, that travels to the court of law to get a settled judgment on, position on that particular element. So section 16, it talks about your eligibility, the documents and the events required when I can credit my credit to electronic credit ledger. From there, section 16, further it says, with respect to capital goods, subsection 3, in case if you have a capital goods, you claim input tax credit, subject to depreciation under Income Tax Act. That means to say, you want to have a benefit of input tax credit. If you have input tax credit, availed indirect tax, don't claim a depreciation under direct tax. If you have not claimed the benefit of input tax credit, you claim a depreciation under indirect tax. That means to say, let's assume that there's a bill for 1 lakh on which I have paid GST of 18,000, PPE, accounting standard 10, when I want to capitalize. I have a choice. I have to capitalize either for 1 lakh 18,000 or 1 lakh. If I have capitalized for 1 lakh, that means to say that I have enjoyed the benefit of input tax credit. If no input tax credit, then entire 1 lakh 18,000 goes for capitalization. This will be capitalization. So this is what mutually exclusive this is that, look, you want to enjoy your input tax credit, then don't claim the benefit of input tax credit under the GST law. If you have not claimed input tax credit, then you can claim your depreciation. That is what section 3 talks about. Then subsection 4 talks about time limit. Time limit to avail input tax credit. Please keep in mind this time limit, they talk with respect to tax invoice, they talk with respect to debit note. So that means to say imports, they are not given any time limit. They say that for a particular financial year, any inward, any purchase which was recorded, this inward you can avail till 30th November of next financial year. When I say 30th November, my availment is through GSTR 3B. Through 3B. When I file my GST 3B under section 39, I can claim input tax credit. So any GST 3B filed up to 30th November, So that means to say my October return, October 3B is the last return by which I should have claimed the benefit of input tax credit. I repeat, to claim the benefit of input tax credit, my purchases for a particular financial year ought to be accounted on or before your return file for October month. Now, this is where your preparation for your tax audit, your statutory audit, your income tax, ITR filing, your annual return under GST. Now, when we as a professional chartered accountants, when we do this activity, our job is to ensure compliances. Year end, 31st March, what are the compliances? Year end after the reconciliation, the compilation, these are the main activities. So any credit which was left out, I can claim this particular input tax credit on or before the return which is filed for your October return. This is what the law says. Moving further, these are the conditions which are there under section 16 with respect to input tax credit. Now, 17 is the main section which brings little broader restrictions and conditions with respect to input tax credit. 17 clearly says that notwithstanding anything said, anything contained, or anything said under section 16 or section 18. Notwithstanding anything contained in section 16 or section 18. Section 16 is your basic condition. When inward supply happens, I use it for business, I can take input tax credit. Section 18 says, sir, I'm a non-registered person. I'm getting registered for the first time. Closing stock, input tax credit. Or I'm under composition scheme, I'm getting converted to regular scheme. I have goods which are exempted now, which are taxable. All these conditions, they say, notwithstanding anything contained in either section 16 or section 18, 17 has a supremacy. They say that you cannot take input tax credit. When? We will understand that. It says that, first point, when inward supply, the goods or services used for other than business, I use the goods or I use services for business other than business. What do you mean by other than business? Like we discussed, no, gift or personal consumption, not for business. We have a basic element when we read our accounting concepts and conventions. We studied something called entity concept. Basic preamble. The person who conducts business, he himself is different, the business is different. So I, as a proprietor, when I buy goods, I use it for my personal purpose. I will not record those transactions in the financials. I will call that as a capital or current account transactions. So here, use for business, use other than business. So if other than business, the law says that irrespective of section 16, no input tax credit. No input tax credit. That means to say, when I have a larger organization, imagine the entity called Reliance or Mahindra and Mahindra, Toyota, Kirloskar. These big organizations, whenever the purchase happens, we have no preamble called purchase order. At the time of creating a purchase order, I decide this particular purchase used for business, use other than business. If it is other than business, no input tax credit. That is what they talk about. Moving further, this is your first criteria. Second, I have purchases, the goods or services, which are used partly for taxable or zero rated supply and partly exempted. Then to the extent of exemption, no input tax credit. No input tax credit. Government said that, look, you purchase goods or services. Those goods you are using for taxable or zero rated, claim input tax credit. So partly I use for exempted activity. What do you mean by exempted activity? Say if I have given goods to central government, state government, those are exempted. Then to the extent of exempted, no input tax credit. There's no value addition in the chain, supply chain. I give to, like, let's take example. There's an entity called A, there's an entity called B, there's an entity called C. Finally, I would say end consumer. A is a manufacturer, B is a wholesaler, C is a retailer, end consumer, let's assume D happens to be a government entity. A sells to B. B can claim input tax credit when B sells to C with the GST. A sells with GST. So A can claim input tax credit. In turn, B is selling to C with GST, then B can claim input tax credit. C sells to D without GST. Without GST. Since C is selling to D without GST, there is no benefit of input tax credit given to C. There is a breakage of my supply chain, the benefit of input tax credit at a particular point. So since C is not making outward supply with GST, the input tax credit gets restricted under section 17, subsection 2. This is what the input tax credit restriction stands. Now, I've used a term called exempted. This term exempted was defined under section 2, clause 47. Let's understand that and come back. Section 247, exempted. Exempt supply means supply of any goods or services. They've used the term supply. That means I sell, or both, which attracts nil rate of tax. The rate of tax is nil. So when I go to the rate notification, there's a goods 1 of 2017. There's the services 11 of 2017. There are different GST notifications where I'll find my rate of tax, which attracts nil rate of tax, or which may be wholly exempt from tax under section 11 or under 6 of IGST Act, and includes non-taxable supply. Supply which is non-taxable, like petrol or diesel, alcoholic liquor, non-taxable supply. Somewhere they would have defined that also. Yeah. 78. Non-taxable supply means supply of goods and services are both which is not leviable, which is not subject to levy. What is not subject to levy? Sale of petrol, diesel, alcoholic liquor for human consumption is not leviable or under GST. These 47 or 78 is called exempt supply. So this is which clarified what is a exempt supply. What is a exempt supply? So what I have to do, I need to understand my business. If I have a turnover, I need to bifurcate turnover into this manner. What is taxable, or what is zero rated supply, and what is exempt. In case if I have a business transaction which is exempt under GST, I need to take a call, sir, I should not take my input tax credit. A classic example. Let's take example this Shell petrol bunk. When I go to Shell petrol bunk, they say, so you buy petrol or diesel. I also do engine oil replacement. I do a couple of lubricants replacement. When they sell this engine oil, that is subjected to GST. When I sell petrol or diesel, that is not subjected to GST. There, for the purpose of this petrol bunk, those lubricant oils which they purchase and sell subjected to GST, petrol and diesel not subjected to GST. So I need to bifurcate my turnover, taxable, non-taxable. Those purchases which are directly connected with taxable, claim input tax. Not connected, no input tax. Let's assume, sir, I'm a owner of a petrol bunk. I buy 1,000 cans of engine oil. Out of 1,000 cans, 50 cans I use it for my own vehicles. Other than business, clause 1. Other than business, no ITC. Out of 1,050, ITC should not be taken. Partly for taxable, partly for exempted. Out of balance 990, say I use 100 for running a DG set which is required for petrol bunk. Again, exempted. I use it for sale of petrol, diesel. I am not eligible. The balance 900, I use it for sale. I can take input tax credit. This is what they say. In addition to this exempt supply, law has added few more things. They say also for the purpose of this exemption, they say in case if you have transactions in securities, then they say this is exempt supply. Like example, sale of mutual funds, equity shares, sale of mutual funds, equity shares, that they call as a supply which is exempt supply. So I buy mutual fund, I sell mutual fund, then it is not subject to GST because of Schedule 3 transaction. But limited purpose to reverse input tax credit, they say that this securities is a exempt supply. Valuation, I'll come a little later. Please keep in mind, if I have transaction security, that is called as an exempt supply. Then sale of land. Sale of land, exempt supply. Sale of building. Sale of building, where this is completely constructed, not partially constructed. Sale of building which is not constructed completely, I call that as a exempt supply. I call that as a exempt supply. Sale of building is also exempt supply. In addition to this, transactions as per entry 8, clause A of Schedule 3. That means to say, goods sold in duty-free shop. Goods sold in duty-free shop in international airport. In international airport, when passengers come into India, there's a duty-free shop. So anyone sells from duty-free shop, that is also covered as your exempt supply. So please keep in mind what is there under 247. Addition to that, this transaction security, sale of land, sale of building, etc. is there. Then they say you should reverse your input tax credit for this exempt supply. What is the homework for us? When we prepare our P&L account, now in P&L account, in general, sale of goods will be there or services will be there. For this, I need to identify, are we having taxable plus zero rated supply, that is exports, or exempt supply? If there is an exempt supply, then no input tax credit. No input tax credit. In addition to this, profit or loss on sale of securities, that is your mutual fund, equity, etc. Profit or loss on sale of land or building. In case if this is also there, then section 17 comes and says, boss, look at your input tax credit. You should reverse your input tax credit, which is directly connected with this particular purchases. This is where your condition comes and sits over here. Now, all this we have understood. How does this 17 comes into restrict my input tax credit? To give you a couple of examples to understand how 17 is going to bring a restriction. To understand, let's take a simple example. So let's say there's a company called XYZ Limited. XYZ Limited. This XYZ Limited, when you look at your purchases, I have security service. I have rent paid for the property. I have professional consultant for accounts, auditing, taxation, etc. Now, if you look at your business, please look at this, your P&L. My P&L, whatever activities I am doing, these activities have common purchases. These common purchases are what we are not talking about this. All these common purchases, I am not eligible to claim ITC. Not eligible to claim ITC. Law says that, look, you understand your business model. If you have these common credits, don't take common credits. So what about specific purchases? Specific purchase. What is specific purchase? Let's take example, real estate agent. Real estate agent. Say, I purchase a property for 1 crore. I buy a property for 1 crore. I sell for 1.2 crore. To make this particular deal, I have a real estate agent who have charged me rupees 10 lakhs plus GST of 18%. Now, this is a specific input service for this transaction. Can I claim input tax credit? This transaction is for an immovable property which is not subjected to GST. When I buy and sell a land or a building, that is not subject to GST. The sale of immovable property is not GST item. Purchase and sale of a land is not subject to GST. Because land is not subject to GST, input tax credit I cannot claim. This is what they say. Similarly, shares, purchase and sale of shares, not subject to GST. I buy mutual funds, I sell mutual funds, not subject to GST. Any specific input tax credit, I shouldn't claim. Clear now?
It's my grade level. When to buy we cannot claim.
Now,
Because I have taken building as a rent, and I pay to landlord.
Landlord, we have paid. In my business, I have taxable supply, I have exempt supply.
Yes.
Proportionately to the exempt supply, I should reverse. Like, let's take example. Very simple example. Let's say there's a milk parlor. The person who sells milk, curd, buttermilk, bread packets, and some other edible items, biscuits, etc. So the building which he has taken, he sells 90% exempt items, maybe 10% taxable item. Monthly is paying 10,000 rent on 10,000, 1,800 GST. Now, can I claim 100% GST? No, 90% is exempt. So I reverse 90%, I take only 10%, the proportionate input tax credit. So this is where the rule, section 17, whatever conditions are there, those are brought under Rule 42, Rule 43. Rule 42 says that goods or services which are commonly used, how do I reverse my input tax credit? Rule 43 talks about capital goods on which I have to reverse my input tax credit with respect to this nature of business model. People are listening online. Mohan, Rutu, Shivkumar, Vikra, LC Hegde, any doubts?
Yes, sir. Yes, sir. In presenting, we are okay.
No doubts, na?
Yes,
No
sir.
doubt.
Okay. Now, moving forward. So this is actually getting into little technical. Pay attention from here. Law clearly says that, look, if it is other than business, no ITC. If it is for exempt, no ITC. Why? My supply chain is a break. Because break in supply chain, when there is no value addition from GST point of view, the ITC should be broken in the chain wherever this exempt comes into picture. Wherever exempt supply comes into picture. Now, with respect to exempt supply, what is defined under section 247? Where nil rate of tax is there. Now, when I say nil rate of tax, this nil rate of tax I'll get from notification 1 of 2017 for goods, 11 of 2017 for services. In addition to this notification, law has defined 4 further elements. Transaction securities. This is a Schedule 3 item. Schedule 3, neither supply of goods nor supply of services. Sale of land, sale of building, no GST, Schedule 3 item. Transactions as per section clause E of entry number 8 of Schedule 3, which is sales from a duty-free shop in an international airport. These aspects, they have brought where Rule 42, Rule 43 comes into picture. Now, this is where law says. In addition, now they have brought a new concept called block credit. Block credit, where they have defined specific category of transactions which are not eligible for ITC, which are not eligible for ITC. Now, this is a condition. Before we understand, like we discussed, in India, I need to have a driving license to drive a vehicle. In India, when I drive, I should drive on the left side of the road when I have to drive a vehicle. Now, this is a law. Law means law. We cannot question the law. Without driving license, sir, I'll drive a vehicle. You drive, police will catch, then he'll do what he has to do. You drive on the right side of the road. You drive, something will happen, or someone will catch hold of you. This is what the law says. So I cannot question the law. Why you have blocked my input tax credit? So the law has defined that, Baba, you should not take input tax credit. Now, what is that? They have restricted. First category is your motor vehicle. Motor vehicle, which is used for transportation of passengers. Transportation of passenger. Not having seating capacity more than 13, including driver. So the law said that, look, if there's a motor vehicle, this motor vehicle was designed to carry what? Transportation of passengers. So if there's a motor vehicle which is for transportation of goods, I can claim input tax. Only that motor vehicle which is designed to carry passenger, whose seating capacity is less than 13, no input tax credit. That means your Toyota, Innova, like Mercedes, Benz, whatever vehicles that four people or 5 seats seating capacity. If the capacity is less than 13, no input tax credit. If the capacity is more than 13, including driver, I can claim input tax credit. Like Swaraj Mazda, where you have 20-seater, 30-seater, 40-seater. Those vehicles which have seating capacity more than 13, I can claim input tax credit. This is what law says. Now, there is an exception brought to this particular motor vehicle. What is that exception? My exception says that if I am supplier of those motor vehicle. So my business is I buy and I sell motor vehicle, then you can claim input tax credit. Or so my business is to transport passengers. To transport passenger. Like this Ola, Uber, like no, I have a business activity where I carry passengers, then you can claim input tax credit. Sir, my business activity is a driving school where I impart training, training on this driving activity. So I use the motor vehicle for the purpose of giving training. Then you are eligible for input tax credit. So first and foremost, they say you have a motor vehicle whose seating capacity is less than 13, including driver, no ITC. More than 13, you can claim input tax credit. So why 13? Why not 4? Why not 5? Maybe prime number, government has decided 13. I cannot question. They say that usually, the company director will not come in a tempo traveler, will not come in a Swaraj Mazda to office. So that's why they say it's a luxury, personal usage will be there. They have restricted your input tax credit on the basis of a seating capacity. This is your first item, which they say block credit. Moving further.
So one question, sir.
Yes, sure.
Motor vehicle, if we hire a motor vehicle and use it for business, in that case, ITC can be claimed.
It'll come little later. Clause C, it's touched upon.
Okay.
You're ahead of me. I'll explain the rules. First is I buy. Now this is your purchase. This is your purchase. Now, some of you might be wondering, sir, I have a company. My managing director has purchased Lancer worth around say 40-50 lakhs. On 50 lakhs, they have paid around say 28%, which is coming around 14 lakh. Sir, 14 lakhs GST. Why should I lose? It is meant for business, they say. Answer is, it's a block credit. Though you have used it for business, claim depreciation, you can then claim input tax credit. Now let's put it this way. So there is a hotel, this big high-rise luxury hotels. You have Taj, Vivanta and all, who have this big luxury cars. Any passenger, any client comes from airport, I have to pick, I have to drop him back to the airport. The worth of car is 1 crore. On 1 crore, assuming I have paid 28 lakhs GST. What will I do? I fit in over here called transportation of passengers. Saying that, so this car is not meant for personal use. These specific clients, they have a specific requirement. They needs to be picked up, they needs to be dropped. If I pay, take them in normal, Swift Desire or Maruti 800, they'll not come into my hotel. So for them, to retain them, I need to have these cars. Yes, you can claim input tax credit. Now, like when I say this answer, again, no, your business requirements, no, gets enlarged. Like, no, we have, creatings, like, no, we need to eat that, we need to eat this. Your business requirement also gets expanded. So in my company, we have a client, like we are into construction or some business. Customer wants them to pick up and drop. I use this motor vehicle for pick up and drop. Can I claim input tax credit? Because they cannot come in Ola Uber, I use it for my business. There, you need to check this. What is a kind of registration? The registration, you have yellow board, you have white board. Yellow board is meant for commercial. White board is not meant for commercial. If you have yellow board, probably you may have answer to claim input tax credit. You have a white board, you have a negative answer. No, you cannot claim input tax credit. Now, this is where people use whiteboard, say, so this is meant for transportation of passenger. Now, most of these hotels, no, you have yellow car. You would have observed in airport, these luxury cars which come, they have yellow board. They don't have white board. So if you have a registration saying that this is meant for business, then yes, you can claim input tax credit. Moving further, from motor vehicle. Now our desire, our will, wish, wants enlarges, where I have a vessel, I have a aircraft. Now we call these days, destination wedding, where people spend lakhs, crores of rupees. Now, the pre-wedding and all, like luxury, beyond tradition, beyond custom. Gone are those days where the marriage and all used to be a custom, used to be a tradition. Now it's more of an extravaganza rather than a tradition or a custom. Vessel or aircraft. Vessel is that ship, boat, what we say. So people know they have crazy ideas. Wedding in aircraft, no, in air. The thali, no, they tie up on the mid of ocean. What happens if the engine fails? So they say that any vessel, any aircraft which is purchased in the ordinary course of business, no input tax credit, no input tax credit. Now these big shots, they say for wedding also they buy aircraft, vessel and all. They say no input tax credit if you have used for your business. Again, whatever exceptions I have said above, the same exceptions are applicable here. So I use it for transportation of passengers. Yes, I use it for transportation of passenger, then I can claim input tax credit. I use it for imparting driving or flying skills, flying or driving skills, then I can give input tax credit. I'm into the business of buying and sell, buy or sell, then I can claim input tax credit. So clause A says your air, vessel, aircraft, etc. is not eligible for. Then further, AB, your repair, your maintenance service, your insurance pertaining to A or AA. This also I cannot claim input tax credit. Though I have a motor vehicle. So you said that purchase of motor vehicle, you're not eligible for ITC. Sir, I too. I have purchased a vehicle. I have regular maintenance, I have repair activity, I have insurance, etc. Even then, I cannot claim input tax credit. For motor vehicle, whatever conditions are there, the repair and maintenance, whatever is there, even that I cannot claim input tax credit. If I am into the business, yes, then you can claim input tax credit. These are your conditions with respect to motor vehicle. Any doubts before I go further? Anyone?
No, sir.
Done. Now comes to the other category called general, where they have brought in further to say, let me come to A is done, A is done, AB is done, then B. You're able to see my Word document, Mohan?
Yes, sir. The writing board we could see.
Now, clause B, they say food and beverage, outdoor catering. They say that, look, whatever food and beverage, whatever outdoor catering is there, you cannot claim input tax credit. Couple of exceptions is there. I'll come little later. First and foremost, personal consumption, food and beverage. Swaha, when I eat, I get digested. It is for my personal benefit. Government feels that no, food and beverage, you cannot claim input tax credit. Similarly, outdoor catering. So when I say food and beverage, then immediately comes is your beauty treatment, your what you call surgery, your physical fitness. So anything with respect to these items, you cannot claim your input tax credit. If there is a food, if there is a beverage, if there is outdoor catering, beauty, surgery, physical fitness, etc., then you cannot claim input tax credit. That is what they have restricted. Food, beverage, outdoor catering, beauty treatment, health, cosmetic and plastic surgery. These are the basic personal nature. In addition to that, Shiv, your point comes here. Your lease, rent, hire of a motor vehicle, which is mentioned in A or AA above. So if you have a renting of a motor vehicle, hiring of a motor vehicle, or a aircraft or a vessel, now these also are restricted for input tax credit. So basic food and all, in addition to your lease, rent and all, are blocked as input tax credit. So whenever we have these purchases, I shouldn't claim input tax credit. Now they say, except when used for the purpose specified therein, that is or life insurance, health insurance. Other than those exceptions, you are not eligible. In addition, they also say life insurance, health insurance. So pertain to employees, sir, for employee, I have taken a life insurance, health insurance. We have key man health insurance. What do we call that? KMI, key man insurance. Even key man insurance, like in partnership accounting, we have joint life policy, JLP. This insurance is not eligible. Is it for health? Is it for life? They say no, it is not eligible for input tax credit. That's your clause B. Now, further they say, provided that input tax credit in respect of such goods and services, whatever I have explained so far, provided the ITC in respect of such goods and services shall be available where an inward supply of such goods and services are both is used. Those goods are used by a registered person for making outward taxable supply of same category of goods or services or as a element of taxable or composite supply. So if I use the above items as a composite supply or mixed supply, I can claim input tax credit. This is what law talks about. I'll clarify this in this manner. I've been talking about food, beverage and all, right? Let's take example. There's a movie. There's a movie production house. In case of a movie production house, you have, so let's take example, this Kelo India, some event or this, TV shows which are happening. You have people like, say, judges, you have host, you have celebrity. Now these are and participants. Now for these people, this production house have to provide, like we have, say, AVM production house. So those production house, they purchase the accommodation, they buy food, they have this travel, the local motor car, etc., luxury goods, all these items they provide. Then they do a shooting. And this shooting gets recorded. And this recorded is given to the channel to host. Now, so these are incidental expenses. These are incidental expenses. So they call this as a composite supply. As a part of composite supply, these are essential for me. So for production house, when they have taken input tax credit of food and beverage, sir, yes, it is eligible. Like, no, there are few people particular. I need so and so restaurant, so and so particular food. Now you eat or not, they say, I need that food. This coffee, I need that particular MTR brand, that particular container I want to drink. The milkshake, so and so particular, Baskin Robbins, some brand. You wanted those particular items where you have to purchase. Now they have a wish list. So when I buy those goods or services for the purpose of outward supply, I can take the input tax credit. So what I have to do, based on the nature of business, I have to decide whether I'm eligible or not eligible for input tax credit. Now, what if, say I'm a a company, I use this leasing renting for pickup and drop of employee, like Shiv was asking. Let's say I have a factory which is 60 kilometers away from city. My managing director, my key employees have to travel. So I hire a four-wheeler which is used for pickup and drop. Answer is no. Here they say that this should have been used for making outward supply. So for my employee pickup and drop, if I use, I cannot take input tax credit. But I use it for billing to my client, then I can take the input tax credit. Similarly, food. So my factory is away from the city. There's no food available. Canteen I have to provide. Barring, which is mandate and law. Here they say, provided that input tax credit in respect of such goods and services, ITC in respect of such goods and services, both shall be available, where it is obligatory for an employer to provide the same to its employee under any law for timing in force. If at all, if my company is under the Factories Act, under Factories Act, I have to provide canteen, then I can claim input tax credit on outdoor catering. So I have a small factory, only 10 people are there. Factories Act is not applicable for me. Can I take input tax credit? Answer no. Only if there is a Factories Act where minimum 50 people are required. I am less than 50, there is no Factories Act, then my food on outdoor catering, food and beverages, I cannot claim. This is where the restriction comes into play. So whatever A, B, we have discussed, they say if it is obligation, then I can claim. If it is not obligation, I cannot claim. Further, they say with respect to membership of a club, health and fitness center. Now, couple of these multinational company, Japanese company, German company, or US entity, they have this membership of a club. These people who come from Japan, US, and all, there will be a big, Bangalore Turf Club, Bangalore Club, City Club, Chennai Metropolitan Club. So these clubs, they have a membership fee, which is minimum 50 lakhs to 1 crore. To give, this is social status. So when I pay 1 crore to a club for a membership fee, on 1 crore, 18 lakhs is charged every year. This is every year. Now, why they pay? No, that's a luxury. They want that status, social status. So any club where I pay that membership fee, I cannot claim input tax credit. It's a block credit. Travel benefits extended to employees on vacation, like LTA. Any, like, no personal consumption, I cannot claim input tax credit. This is your clause B. This is your clause B. Any doubts before I go further? Food and beverage, outdoor catering, lease rent of a motor vehicle, club, and all is a block credit, which are personal in nature. Please keep in mind, losses which are of more of a personal consumption, block credit. Exception to this, I use as a mixed supply or a composite supply to make a further supply, I can claim. Otherwise, no. If it is mandated under law, I can claim. If it is not mandated under law, I cannot claim input tax credit. Any doubts?
Point. For the furtherance of business.
Furtherance of business.
So taking that as an umbrella, when I'm providing a car for a key personal employee to reach the office or the factory, again, working for a company.
Your point is valid.
They will be at the generation of the business where the government is getting the benefit of tax.
Here, look at the starting point, section 17. Notwithstanding anything contained in 1618, I have put a non-abstinent class. Your argument is well and good.
But you say it's overriding.
I have defined, yes, overriding. Notwithstanding use for business, this is a block credit. I cannot question. Now, someone actually made a challenge in the court. Said, why you're, though it's meant for business, why are you blocking this input tax? Law say, look, as a judge, I am not party to this law. Who made this law? This was made in the parliament. Who have made? Who are the people in the parliament? The elected representatives. Who elected them? So, if a donkey made a law, the judge said, who elected that donkey? So, you are a donkey because you have elected that donkey. So, this is how few things, though we want to question, we cannot question. The courts will say, law which is enacted by parliament, as a court, I don't have anything to say. At best, I make a recommendation to revisit on that. Barring that, I cannot do anything. If that law was made in such a fashion which violates your Article 14, fundamental rights, Article 19, which blocks your input tax credit. Like example, one beautiful argument, Article 19, Clause 1G, your competition. We have CII, Competition of India. Your policy, your GST policy of input tax credit is encouraging one set of business, discouraging one set of business. Then court will interfere and say that, look, one particular business sector you are allowing, one particular business sector you are not allowing. Invoking this Article 19, they will say, change the law. So if at all it is one-sided, if it is biased, then courts will interfere. Otherwise, they will not interfere. That is what we have to do. Moving further. Then I have clause C. This is where the biggest dispute starts. Works contract. Works contract. Works contract by provided by works contract provided by a contractor. When I say works contract, This is generally in relation to construction, repair, maintenance, construction, repair, maintenance. These are all activities are forming part of construction. To the extent of capitalization. To the extent of capitalization, no ITC. Like example, factory construction or wall construction or civil work, which I have capitalized in my books. Capitalized as building. All this is a block credit. Let us just read that clause C and come back. Works contract service. Service is when works contract service. Service is when supplied for construction of a immobile property. Immobile property is your building. Land also is there. For land, there is no construction. At best, there will be a development of a land. A barren land, development into plots, that's a development on, that's a works contract on a land. Works contract service when supplied for construction of a immobile property other than plant and machinery, except where it is an input service for further supply of works contract. The exception is I use that for further supply. Exception is that. Where explanation, construction includes reconstruction, renovation, additions, alterations, or repairs to the extent of capitalization to the said immobile property. So this construction includes construction, renovation, addition, alteration, where they have excluded plant and machinery. They have excluded plant and machinery. So here, this construction, I get it done from a contractor. This is a third party who do that. Alternatively, what I can do instead of giving to a third party, I buy inputs, I buy input services on self basis for construction. So the law says that, look, you want to construct a building, you give entire contract to a third party. So there is an engineer who comes with material, who comes with labor, he constructs the buildings and give to you. That's clause C. Clause D, I have my own people, I have my engineer, I have my labor. So what I'll do, I buy material, I buy few outsourced hired labor, and I do construction on myself. Both the cases, you're not eligible for input tax credit. So the exception over here is, exception what they say is, I buy works contract service to supply works contract service. Supply works contract service. Like example, say ABC happens to be a main contractor, where there's a company called XYZ Limited. XYZ Limited wants a building to be constructed, This building, they have given a work to ABC. There's a individual contractors called PQR. Now, these are individual contractors. So when P gives a works contract service to ABC, Q gives to ABC, R gives to ABC. Now this ABC in turn bills back to XYZ as a works contract. Then whatever PQR billing, ITC is allowed for ABC. ITC is allowed for ABC. This is what law says. Now, here, while talking about works contract, While talking about works contract, they say other than plant and machinery, other than plant and machinery. This is where your complexity in the business comes into picture. Where, let's take example. Say in a factory, let's assume that this is my incoming where raw material store is there. Raw material store is there. This is where my production starts. From here, my production starts. Where mixing happens. My raw material mixing happens over here. When I mix raw material, I use a boiler. I use a boiler. Boiler is where certain temperature, lot of heat, like you boil the water where steam gets generated. This chemical which is mixed is put into boiler. The output of boiler is in a heated position. Now to carry this, I have a crane. Assuming that this is my slab area where the whatever output of here is there that needs to be traveled to this area. So I have a crane. Say this is my civil structure. Using a civil structure, a crane used to transport the output of one area to another area. From slab area, I have a cutting area. Again, I use one more crane to transport this material from this area to this area. Now, these are not hand lifted. It is of a high weight in nature. Now, this I call as a EOT crane. A crane which is not traveling horizontally, which is traveling vertically. Horizontally to move from one area to another. Vertically, I lift, I take, I drop. Lift, take, drop. Now, these EOT cranes to operate, I need to have a civil structure. Now, to visualize this, imagine your the shutter. The normal shops, you have a shutter. To operate the shutter, I need to have a support. That support we call as a civil structure. This civil structure I call as a works contract. Now, this is in crores of rupees. To operate this crane, the crane may be worth around say 5 crore. To operate this crane, I need to have a civil structure which is worth around 1 crore. On 1 crore, GST I pay is 18%, 18 lakhs. Now the law says that no, you should not claim input tax credit if it is in relation to civil structure. So the law has got a explanation under 17. Explanation says any apparatus, any equipment, any machinery which has got a foundation or civil structure to operate and make outward supply, then ITC is allowed. ITC is allowed. Now, in general, they say that whatever machinery, like AEM, keep in mind AEM, apparatus, equipment, machinery. Any apparatus, equipment, machinery requires a foundation. Sir, how do I operate? Without foundation, I cannot operate. Without civil structure, I cannot operate. So, like we call wobbling effect. If it is not permanently fastened, it falls on an employee. It is incapable for its operation. So the law says that wherever you talk about this particular civil work, this works contract, they say other than plant and machinery. All this they say other than plant and machinery. Now, question comes here. Sir, I have a EOT crane. For EOT crane worth 5 crore, I have spent 1 crore worth civil structure. You have this accounting standard 10 PPE. Will I capitalize 1 crore separately as building, or will I capitalize that civil structure part of EOT crane as 6 crore? This is where accounting principles come to assist me in terms of deciding whether ITC is eligible. So here, why did the civil structure came into picture? Sir, because EOT crane is there, to operate that EOT crane, I need to have civil structure. If this EOT crane is not there, civil structure doesn't come into picture. Parent-child concept. This child asset came into picture because of a parent asset. So when I capitalize this together, all this civil structure, no, I call work in progress. A point in time, I put into plant and machinery. So if I incur expenses which are put into plant and machinery, I can claim input tax credit. If I've incurred expenses, instead of putting into plant and machinery, I put the EOT crane into plant and machinery. I put that civil construction into building. Then this I can claim ITC. This I cannot claim ITC. This is what the law talks about. Are we clear?
Yes, sir. Yes, yes.
No doubts now?
No, sir. No.
We have to take the support of coding principles to determine the plan which will be. Then only you can talk about claiming the rights.
Yes. So here, what we speak should be appearing in our books of accounts. How do we present in our financial statements is also important. If a claim depreciation, I have put ITC to assets, no ITC. Similarly, I have to prove that this civil work is my plant and machinery. So mere construction of a building, like one argument, sir, because you say if it is plant and machinery, you are allowing ITC. I construct a building. Let's take an example. There is a building where this is my reception area. This is my finance and accounts admin area. This is my raw material store. This is my manufacturing. This is my trading. Finally, this is my say canteen, food and canteen, other miscellaneous. This entire building used for business. I call this as plant and machinery. Please give me ITC. Accounting, they say accounting, you say it is building. For indirect taxation, for GST, you say that this is a plant and machinery. Acceptable? I say that it is a building. Allah said that I use this for the purpose of business where entire this activity happens. So I say one thing, I do something. It doesn't go. What is that you have shown in your books of accounts as a building or plant and machinery should also replicate its usage. Then I can claim my input tax credit. This is what we need to understand. Clause C, Clause D, goods and services used by taxable person on his own accounting. Explanation 1, explanation 2. Yeah, one more. For the purpose of this chapter, expression plant and machinery. This is what law has defined. Means AEM, apparatus, equipment, machinery, fixed to earth by foundation or structural support. Why do I do that? That is used for making outward supply of goods or services or both. So without fixing that, without civil structure, I cannot operate. Then I can call that as a part of plant and machinery. Like example, machinery, like when a big machineries are there, there is a the foundation, the plinth, they take the civil structure support so that the wobbling effect is not there. If machinery is oscillating, like no one can function. Not to have that wobbling effect, I do that civil structure. So that civil structure should also be part of your plant and machinery. So what we generally do is we call WIP, work in progress. Anything we incur, we don't capitalize. We put into WIP. After the work is over, I transfer to a asset called plant and machinery. This is what your C and D talks about. Then rest you have clause E, purchase the goods and services, what I buy from composition person. Any person who's under composition, because that's a minimal rate of tax, no ITC. Goods and services received by a NRTP, we don't deal. Any person who comes to India who's a non-resident, he'll be called as a non-resident taxable person. That person, goods and services which are purchased by him, cannot claim input tax credit. Similarly, FA, this is your new entry with respect to CSR activity. Any company who buy goods and services received by a taxable person, which are used or intended to be used for activities relating to obligation under CSR, I cannot claim ITC. Like these days, when you make a profit, I need to spend so much of money on CSR activity. So there's a government school, there's a government college. I spent 10 lakhs for construction of a particular library room. For construction, I have spent 10 lakhs on that 1.8 lakhs. Can I claim input tax? No. If you have spent money for CSR, no input tax credit benefit. Goods and services which are for personal consumption. Other than business, no input tax credit. Now, clause H, most of the time we have audit complaints. Goods lost, stolen, destroyed, written off, disposed by way of gift or sample. You remember business gift. I gave as a business gift for the purpose of promotion. So anything which you have given as a gift or sample, no input tax credit. Goods lost, stolen, destroyed, write off. I'll explain that. Goods lost, stolen, destroyed. Now, when we have production, I have something called normal loss, abnormal loss. Now, this or this I scrap. On scrap, I may pay GST at a scrap value. Goods lost. Can I say lost as a normal loss? Or can I say this is an abnormal loss? There could be a physical loss. So I have 50 laptops, 2 laptops are missing, lost. Goods lost, no ITC. Goods stolen, theft, no ITC. Now, but when they use in terms of this production, normal loss, it is normal, which is like, when I have costing, my costing, I take care of this normal loss. But abnormal loss, I don't take care. So anything which is abnormal, I can call as lost. No ITC. No ITC. If there is a abnormal loss. Goods destroyed. Now I manufactured goods. I have manufactured goods. This is redundant in nature. I have given a sample to my customer. This sample got rejected. So what will I do with this finished goods? Once if it is rejected, I destroy those goods. So anything which is of abnormal nature, 17.5 comes and says, identify your raw material, identify other purchases, which is sitting in your FG or SFG. If anything which is destroyed, I have to reverse input tax credit. Japanese companies, very stringent on quality. I'll give an example. I remember there's one company, which is a Japanese company. When they have set up a factory, they have not drawn power from the local state government. What they have done, They have installed a DG set for production of power to the manufacturing process. Like if I draw from the state government, from the grid, if I draw power per unit, the cost would be around, say 3 rupee 50 paisa. 3 rupee 50 paisa. But if I have intensive, the DG set captive power generation. By captive power generation, I'm spending 6 rupee per unit. So generally, now as an auditor, what we say, are you fool? You're spending more than 2 rupee 50 paisa per unit. Why do you want to do that? They say, no, we don't trust your Indian power. They say, any mild fluctuation in your power will have an impact on my manufacture. So I don't trust. So I have my own power manufacturing. Initially, no, they did majority of these Japanese companies who have set up Toyota, other Honda, they had their own manufacturing power. They said, we don't trust your Indian power. Later, they have this LPG. Now we have, other than LPG, new power, CNG. Now, CNG is the latest thing. Majority of these manufacturing companies, they don't depend on our the BESCOM, ESCOM. They depend on their own captive power consumption. This is what they talk about quality. So please keep in mind, any goods lost, stolen, destroyed, given as gift, sample, I cannot take input tax credit. Like again, sample. Sir, I am a pharmaceutical company. I'm a pharma company. Now, if I manufacture 10,000 pieces, now doctors don't get to know my product. Out of 10,000 pieces, 1,000 pieces I have to give a sample to the doctors. Only when doctors, they don't try on themselves, they try on the patients. When the patient is successful, then they place an order. To sell this 9,000 units, this I have to give as a sample. Can I claim ITC? Answer is no. Though it is for your sale of that 9,000, because you are giving as a sample under 17(5)(g), there is a restriction. You cannot claim input tax credit. This is what the clause H talks about. Any tax paid under section 74, when there is an audit, as per the audit, you're paid GST. That GST is under section 74. You cannot claim input tax credit. Further, the government may prescribe restriction of input tax credit under 1 or 2 as may be attributed. Now, these are the conditions which they have brought with respect to your input tax restriction under 17. If you are clear, I'll come to the rule 42 to understand better. Any doubts? Motor vehicle, aircraft, vessel, food, then your hotel, what do you call this, membership club fee, other than which are provided under mandatory under law.
And incidental expenses are those.
Incidental expenses also ineligible. If, like now I gave this example of production house where it is a composite or mixed supply, then I can claim input tax credit. Like your hotel, this car, pick up and drop, because it is a composite supply, I can take the input tax credit. Works contract, examination always will have one question for 4 marks where they apply this concept of AEM, apparatus, equipment, manufacture, fixed to earth through a foundation or a civil structure for its intended use of outward supply. I'll go further. Now, rule 42. Rule 42. They say that for a particular tax period, now you remember this example, we get into that. Let's assume that there is a business. This particular business deals with goods which are taxable, which are zero rated supply, goods which are exempted. Now for these particular thing, I have common goods or services. These goods or services, like example, rent you may have, air conditioner you may have, security services you may have, telephone you may have. What else? Consultancy, audit, legal you may have. Then purchase of your raw material, which may be common used, like no consumables, I would say, raw material or consumables, which are common in nature for both the activities. How does Rule 42 will help you for this particular input tax credit? They say that for a tax period, let T be your input tax credit for a tax period. Out of this total input tax credit, let me identify, set T1, other than business. Please keep in mind, Rule 42 is for your input goods and services. Rule 43 is for your capital goods. We are talking only about Rule 42. If T1 is there, other than business, it is ineligible. T2, there is a inward supply of goods and services exclusively for exempt goods or exempt services. I have T3, which is used exclusively for exempt goods, exempt services. Let me come to Rule 42. Starting point is your T1 intended to be used other than business. T2 used exclusively for exempt supply. Then one is your other than business, exclusively for exempt. Then they have brought T3, which is defined as block credit. Block credit under section 17(5). Whatever we have discussed, motor vehicle, aircraft, vessel, food, personal beauty treatment, cosmetic surgery, membership fee, works contract, everything like no loss, abnormal loss, goods loss given as a free gift sample, that is under T3. Out of total credit, other than business, exempt supply, block credit, whichever is identifiable. T1, T2, T3. From there, they come to further. The amount of input tax credit in the credit ledger of a registered person be C1, which is T minus T1, T2, T3. So they say that the input tax credit, the credit which gets credited to electronic credit ledger, they call C. C is equal to, out of total credit, T1, T2, T3. This is what I have to eliminate. I get a credit where I'm eligible for input tax credit. Then what do they say from there? Then the amount of ITC on input services intended to be used exclusively for the supplies other than exempted can be called as T4. That is your eligible credit. So from C1, they have removed this T4 where I'll get my common credit. They have called my credit which goes to the credit ledger is C1, which is other than this. Out of this, they wanted to have T4, which is your input tax credit eligible because it is used other than exempt, but which is used for zero rated supply. That means to say, in simple terms, T4 is your taxable and zero rated supply. So what we have to do whenever we have purchases, remember this business model, purchases directly for taxable, I'll call as T4. Purchases directly for exempt, I call this as T2. So this is how I identify T4. Now my common credit will be C2 is equal to my credit which is derived here, that C1 minus T4. Now this is your common credit for taxable and exempt. Taxable, which includes zero rated, and exempt supply. So I'll be left with a credit which is called as a common credit. I'll repeat once again, have a better understanding. I'll start like this. During a month, whatever purchases I have done for input goods, input services, other than capital goods, this is my starting point. This is my starting point. I call it T. From this total credit, I'll identify the credits which are other than business. Other than business, so I use it for my personal consumption. So I have given as gift donation. I'll remove that T1. Then T2. Those purchases which are pertaining to exempted activity, directly I'll get to know. That I call as T2. Out of the remaining list, I have T3, which is blocked under 17.5. When you look at your purchases, so this is motor vehicle ineligible. So this is for outdoor catering ineligible. This is given by way of gift ineligible. So that's how T3 comes into picture. Then T4, whenever I purchase the goods or services, I get to know that these are exclusively used for my taxable activity, which I call as T4. So government said that remove that T4 from your common credit, which is your specific credit, which is your common credit. So C1 is your eligible partly for taxable and exempt. Now from here, I'm removing T4 where I'm getting my common credits. This common credits is where I need to reverse. So they say that your ineligible credit, my ineligible credit will be D divided by E into C2. They say that D is your exempt turnover, E is your total turnover in a state. Total turnover in a state. This is where you will find out your ineligible common credit with respect to common credits. Now, this turnover for a tax period. For a tax period. This is for a tax period. So what happens? Like, let's assume that month 1, month 2, month 3, so on, month 9, month 10, month 11, month 12. When I look at this pattern, so I have a turnover in month 1, I have a turnover in month 2, I don't have turnover in month 3. So on, I have a turnover here, I don't have a turnover here, I have a turnover here. So when I do this formula, ineligible credits, month 3, when I don't have a turnover, what will I do? The law says that travel to month 2. Apply this ratio over here for month 3. So when you say what is the turnover for exempt activity, what is the total turnover during the month into common credits, you get your ineligible common credits. This is how I calculate for month 3. Now, this is what I do. Step 1, do Rule 42 calculation every month. Step 2. If turnover not available for particular tax period, for a particular tax period, look for previous tax period. This is what I do every month. Step 3. Redo T1, T2, T3, T4, C1, C2, and D, that you're ineligible credit for entire year. That means to say, earlier you're doing monthly basis. In step 3, I do for 12 months together. Law says that every month you have an individual ratio. Now, there could be a possibility that 1 month you have a higher turnover, another month you have a lower turnover. Like your purchases are not uniform, your sales are not uniform. Say, in this month, my sales is higher. In this month, my sales is lower. But what happens? So my purchase happened in this month, which got consumed in this month. My purchase which happened in this month got consumed in this month. So there could be a disparity with respect to the ratio. So the government says that redo this entire activity for 12 months, that is for a financial year, again in the month of April. In the month of April, redo this. Government feels that you don't have any work, do this. So I have done this. Step 4. Now compare result of step 1 with step 3. Now it may so happen that like output, my output, or I would say scenario 1, my monthly reversal is higher than annual reversal. Scenario 2, my monthly reversal is less than annual reversal. So when I do month-on-month reversal, when I add the 12 months, that is either higher or lesser compared to what I do for 12 months together. Now, what does the law say? For monthly reversal, if it is higher than annual reversal, if scenario 1 is there, they say avail that ITC up to September. Law has given a time of 6 months. Since you reverse more than what you should reverse, on or before September, you claim it back. Scenario 2, where I have reversed less than what I have to reverse. They say, pay the short amount. Pay the short amount with interest. Starting from 1st April. Starting from 1st April till payment. Starting from 1st April till payment. This is what they are expecting in your Rule 42. Looks like complicated, but this is the law. No choice. When law is there, except honoring the law, I don't have any other choice. I don't have a shortcut. Now, that is why this course called CA or CMA is said complicated or so tough. Where an ordinary person cannot do, extraordinary person has to do that. So this is what I have to do for entire month on month. Again, sit back and do it for 12 months together. If I have short reversed, reverse with interest. Excess reversed, avail before September. If I don't claim within September, gone. Whatever excess reversal you have done, the input tax credit is gone. I'll just give one example to understand this particular formula, what we do. Let's see the purchases for a month. The purchases for a month. I'll give scenarios. Goods purchased for own building construction. Then services received for auditing. Raw material purchased for taxable and exempted together. Then consumables purchased for taxable. Then outdoor catering received for canteen. Then raw material purchase for exempt activity. Then I have security services, security, telephone for a tax period. Then let me say goods purchased for donation. Now, all these purchases will come and sit in your starting point called T, the common credit, the basic credit. Now, from here, I'll start segregating T1, T2, T3, T4. Goods purchased for own building construction. Building construction, 17.5, Clause C, Clause D. Clause C, I give to someone. Clause D, I do myself. So this I'll call 17.5. 17.5, where does it go? T1, T2, 3. Look at your T1, T2, T3. Look at your T1, T2, T3. Where does it go? T3. So first item, I'll call T3. Then services received for auditing. This is a result. Now it is a common credit. Where do I get the common credit? My common credit is C2. I am getting a result. Correct now? So this will be a resulting item in your C2 when I do the formula. So this is a result of C2. Raw material purchase for taxable and exempted. So what I have to do? Identify this as T4. Identify this as, like I have 1,000 pieces. Like I ordered 80% to taxable, 20% to exempt. Now the moment I receive, sir, 800 pieces for taxable, 200 pieces for exempt. So taxable, I'll say T4. Exempt, T2. Then consumables purchase for taxable. For taxable. Exclusive for taxable. T is your total credit. T4 is your ITC eligible other than exempt. That is your taxable and zero rated. So this specific T4. Then outdoor catering received for canteen. 17.5 block credit. T3. T3. T2 is exempt. T3 is the block credit. Raw material purchase for exempt supply. T2. Other than T1, exempt is T2. Security telephone for a tax period. This is a result which comes in C2. Result of C2. Then goods purchased for donation. Other than business. Other than business. T1. Starting point. Look at your T1. Other than business. Right? So it will be T1. So when I have purchases, this is where our activity of T1, T2, T3, T4 will come into picture. Clear now? Now, for doing this, I'll get my CA degree. For doing this, a client pays us 10,000, 15,000, 30,000, 40,000 every month. Just like that, like, see, not everyone can do this. Because law is so complicated, because business is so complicated, they need support of a chartered accountant or a cost accountant who has a proficiency. And this I have to do every month. If I don't do every month, what happens? I claim input tax credit, which is used for payment of output tax, which is not eligible as per law. I need to pay back this tax along with interest and penalty. Clear now? So this is a necessity for me to understand Rule 42 from application point of view. Any doubts before we wind up?
Again, I said, when it comes to canteen,
Huh.
you again would determine is
Huh.
the Practice Act or.
Yes. If it is mandatory under Factories Act, eligible, it will come to T4. If it is not coming under Factories Act, then 17.5 block credit.
We have to do this exercise based on purchase.
Based on purchase, every line item I have to see, apply the T1, T2, T3, T4 and find out C1, C2. Mohan, Rutu, Shivkumar, Vikra, LCD.
Maybe 42 need a little more time to understand, sir.
But overall concept is clear, no?
Yes, sir. Yes.
Yes, sir. Yes, sir.
How do we apply the T1, T2, T3, T4? That is clear, no?
Yes, sir. Yes, sir. Yes.
So this we read maybe 5 times, then we'll understand. Not that we remember, not we will remember one shot. So if you remember, then you're like a Ekalavya Sishya.
Sir, is it possible to give a numerical example in the WhatsApp group?
Yeah, I'll give that, sure.
Okay.
I'll put various examples. I'll give this T1, T2, 3, T4 computation and I'll share it by end of the day.
Thank you. Thank
Fair enough?
Yes, sir. Great.
Yeah. So then we will discuss in detail Rule 43, capital goods in coming class Monday. In addition to Rule 43, we have this ISD concept and goods sent to job worker is one more concept. So these 3 topics we'll discuss on coming Monday. Till then, see you all. Bye. Good day.
Yes. Thank you, sir. Thank you so much.
Yes, sir. Thank you, sir. Thank you.